It's 5 o'clock in London, it's midday in New York, midnight in Hong Kong, 2 a.m. in Sydney, and 9 a.m. in San Francisco, and 9:30 at night in Mumbai. Greetings, good morning, good afternoon, good evening, depending on where you are in the world today. My name is Patrick L. Young, the IPO-VID livestream, Series 26, Episode 4. In the aggregate, that makes for episode number 154, starts here. Interesting news from the London Stock Exchange Group. They could be looking to sell £500 million worth stake in Euroclear. That's 4.9% of the Euroclear behemoth. It would amount to, well, a handy doubling of the money. They paid about $311 million for it. They could be selling it for as much as $670 million. Of course, the question arises, what exactly does the LSEG have in mind long-term for its markets if it's selling its settlement interests? Speaking of clearing and settlement interests, nobody seems to know what the ASX have in mind with their clearing and settlement interests. The RBA, the Reserve Bank of Australia, the latest to issue a truly scathing report on the quasi-permanent failure of tech advancement, which has become the modern generation of ASX. How long will this farce continue, we wonder? Another farce, well, another interesting drama, I suppose someone might call it, which we have no idea how long that's going to run for. The Deutsche Börse and Nasdaq were raided by European Union antitrust this week. No further news after that. What financial derivatives issues are being investigated remains the question, and how does this impact the concentration monopoly exchange concept the European Commission was keen to promote during the summer? Our guest today, ladies and gentlemen, is Aaron Kaplan. The topic, Prometheum, blockchains, markets, and the future of finance. Rising and exciting stuff. Aaron is the co-CEO of Prometheum Inc. Its affiliate, Prometheum EATS, offers a blockchain-enabled ecosystem for trading digital assets. Another affiliate, Prometheum Capital, engages in clearance, settlement, custody for digital assets. Aaron was previously a counsel at Guzrai Kaplan Nussbaum law firm in New York City. Aaron, welcome to the show. Where in the world are you today?
Hi, Patrick. Thank you for having me. I am in New York City.
Excellent. Good to see you in New York City. How's the weather in New York? We saw you there a couple of months ago when it was stinkingly hot. Have things turned in a slightly more pleasantly forward direction?
I think we're in the Goldilocks period when it comes to a lot of climate issues, and New York is pleasantly enjoyable right now and often in the summer. So we're pretty lucky for the next, hopefully, 10 to 20 years.
Sounds good altogether. So tell me, Aaron, how did you get into the wonderful world of, first of all, capital markets, and then let's move to the distributed ledger and beyond after that?
So my background is as a securities attorney, and I was also on the retail side of the brokerage industry. And as Bitcoin came out, and then had the ICO boom and Ethereum beyond that, we always believed that digital assets were properly regulated under the securities laws. And we actually wrote our first no action letter to the SEC in April 2014, requesting that they not take action against us should we trade Bitcoin through an ATS and a brokerage account. So from there, as the industry matured, and finally when the Dow report came out, which was the first time that the SEC essentially said that digital assets, or at the time virtual currencies or crypto, was regulated and should be regulated under the securities laws, we started the business shortly thereafter, I think in September, October 2017. And from there, we've just set out to build a market infrastructure that sort of integrates the benefits of distributed ledger technology with the benefits of the securities laws.
So the benefits of the securities laws, if I may say so, that's not something you always hear from crypto digital assets advocates first up, Aaron. So tell me a little bit about that, how your background in the law led you to believe that we need regulation.
So if we look at the history of the securities laws, they basically have the 33 and 34 Acts, which came after the 29 crash, and then you have the Great Depression. And essentially what the idea is, you need to have mechanisms to protect investors such that they can properly participate in the space. And another way to ensure that is you have to ensure that the intermediaries are properly regulated. And you then have a development of a lot of laws over the course of generations, which are basically meant to achieve those goals. And when you look at what we do is really the intersection of three areas. It's financial services, it's securities regulation, and it's distributed ledger technology. And given our background, the company was incubated out of a securities law firm, Gus Ray Kaplan Nussbaum, which I was of counsel at, which you mentioned. We had extensive experience in owning brokerage and clearing firms, so we had experience on the financial services side. And then we had been in the distributed ledger technology space since 2013, 2014. So we were able to really combine those three areas in a means where we could build the market infrastructure that's necessary. And I think a lot of the times what happened, particularly in the crypto space, is people were coming from a different angle. Either they're coming from the payment space or they're coming maybe from the engineering side. And that doesn't really take into account the fact that just financial instruments that people invest in, particularly the retail public, are regulated and often under the securities laws. So it was our opinion that there's no need to recreate the wheel. Let's use the rules that have been established and try and test it over generations and build this new infrastructure.
That's a beautifully elegant surmise of what's going on. And I think it is interesting, as you say, how a lot of people have originated out of other areas, payments. I mean, when they started the blockchain island concept in Malta, everybody was coming out of the gambling business, which I think was probably not a really, really good place to start the iGaming industry, because it didn't necessarily lead to an understanding of regulation. And that certainly did develop something different. We've got a couple of comments I see already coming in. Thank you very much. If you've got any comments or you'd like to ask Aaron a question, please fire ahead. We are live right now on LinkedIn, Facebook, and YouTube. So from a LinkedIn user, and I must say my masculine intuition suggests that having read this, I think I know where it's going and who's it's come from. Hello, Patrick and Aaron. I enjoyed listening to the old kids on the new block chat last time in your office in New York. So I think that must be coming from my wife, Bata. Thank you very much for that one-liner, Bata. Really much appreciated. Catch her PhD tomorrow with Elaine Montilla, incidentally, same time and on the same social media, but slightly different channels for women on it. LinkedIn user, hope it's not too big a question to ask. What are the key, it is a big question, but it's very interesting. What are the key challenges and opportunities for companies like Prometheum? How do you see the regulatory framework shaping the future of the industry?
So the opportunities are immense because there's two generalized sides to that. One is traditional markets. When we look at exchanges and the post-trade side, whether it's clearing firms and DTCC, there's major opportunity there because when you integrate the benefits of distributed ledger technology into market infrastructure, you're arguably creating a better apple cart, meaning you're introducing efficiencies that aren't possible with the current market infrastructure by removing a lot of the sort of legacy players in the life cycle of an asset. You eliminate transfer agents, you eliminate DTCC, you eliminate a lot of the entrenched players by basically having those assets exist on chain natively. Now, the second major opportunity is on the, let's say, the people call it the crypto side. We would call it on the digital asset security side. And the major opportunity there is to basically introduce and integrate the benefits of investor protections, of disclosure, of a lot of the concepts of the securities laws into that sort of crypto markets in order to ensure that investors are properly participated and that the crypto industry could take on their next billion users.
Wow, that's a big number. The next billion users. I love that. And that's what we call New York style ambition there, Aaron, coming in instantaneously. So very, very interesting. But I mean, unpacking that for just a second. I mean, good grief. I've been in this sort of capital market revolution business for 25 years, and I know full well that there's a lot of times when you get taken out for what seem like the most pleasant of steak dinners, and they turn into the mostly savage, passive-aggressive fests of "you're not eating my lunch, boy." You blithely incur, a couple of comments there, like we can get rid of transfer agents, we can get rid of DTCC, and so on. Is that really possible?
So it's possible in certain ways. It won't be possible in every way. So people talk about like equities transitioning from their current universe to on-chain with existing equities. That's going to be a little hard. With new equity issuances, possibly. Now, the question would be, why do people want to issue assets on-chain? You want to issue assets on-chain for one of two reasons. One, you can create novel features to that assets, like with a money market fund that does a distribution or an earn every hour instead of every day. But the other reason, and this is one of the primary reasons that I think a lot of traditional securities will migrate to a blockchain, is specifically because it's just more efficient. It's a less expensive process. And I think that that's why when you look at blockchain is not a panacea. It's just a technology that's being integrated into a market infrastructure to allow efficiencies or allow for certain innovations. And innovation, when you cut it like really down to its basic concept, is just the idea of saving users, whether it's the issuers, whether it's the investors, saving them money. And by having assets exist on chain, you're able to do that by sort of eliminating those legacy processes. Now, I understand why people would say, there's certain elements of it will not change, but a lot of elements will. I think when we look at different parts of the securities market, I mentioned money markets, you have these sort of the novel features that can happen with issuing those assets on chain. But another area where you can make an argument that there'll be a lot of sort of efficiencies introduced would be with issuing treasuries on chain. Because by issuing treasuries on chain, essentially you could eliminate the breaks that occur, which then make it more difficult on the back and the middle office side. Because when an asset is issued on chain, you basically eliminate the overall majority, if not all, of the broken trades. And in addition to that, you'll have instantaneous settlement, which will then allow for additional efficiencies to be unlocked in terms of sort of counterparty risk and the time value of that money. So there is a lot of parts of the markets that I think can potentially be disrupted by integrating distributed ledger technology into market infrastructure. But I think this is more an evolution of markets, sort of like when markets went from paper to electronic trading. This is going from the next step from electronic to digital.
I think it's a very, very interesting series of points you make, because certainly one of the things I notice is that we do get each revolution is really ultimately stages of evolution in financial markets. I mean, they don't go in and behead the management of all large organizations or take out the regulators and then change. Everything changes over time. I think the bond market is a very, very interesting issue. As you say, the opportunity to issue any kind of an asset-backed interest-paying security, you can decide when to pay the interest and you can automate that all the way through. That strikes me as being absolutely a fabulous opportunity. And indeed, it can change the structure of how people interact with their money and their monetary investments. So I mean, it's really, really interesting. Ladies and gentlemen, if you're enjoying this show, can you send us some love, please? We would really, really appreciate it. Apart from anything else, artificial intelligence, you wouldn't think artificial intelligence needs love, but it does need love on this show, because the more love, the more likes you give us, the higher we go in the algorithms. The higher we go in the algorithms, the more chance there are for more people to learn more about markets with our illuminating guests like Aaron, who's talking about Prometheum, blockchains, and the future of finance today. And it's most interesting, drawing out several questions. Women on it have got a great question here. What's Prometheum's approach to addressing the environmental impact of blockchain technology? How do you see the industry evolving to become more sustainable?
I think a lot of the concerns associated with the environmental impact had to do with proof of work versus proof of stake blockchains. Proof of work blockchains, you had to have a certain amount of computing power to solve the equation in order to unlock the next block and get your token reward. And a good example of that would be Bitcoin or the initial Ethereum blockchain. But Ethereum eventually switched to proof of stake. And I think the overwhelming majority of blockchains are on proof of stake or something beyond that now, which aren't as energy intensive. So I'm not sure it's as big of a concern as once existed.
Very interesting answer. Thank you very much. Thank you for that question, woman on it, coming from the environmental meets technology side of female IT there. So, I mean, you talk a lot about this, and I must say it's really fascinating, the integration of distributed ledger into market infrastructure. And you've also touched upon the idea of the creation of novel products. So is the way we're going with blockchain going to be particularly more a phenomenon for the retail investor, or is it going to remain a balance between retail and institutional investors?
So it has to be bifurcated here. One is the idea of crypto. Crypto uses blockchains to issue assets on a blockchain. It's a cryptographic token which represents that asset. And from a crypto sense, that's arguably more retail. But from a general market infrastructure sense, it's just technology. So it's ubiquitous. It's just a question of integrating that technology to upgrade markets. And that will impact anyone who's investing. Now, on certain sides, you'll have, on the sell side, you'll have issuers looking to issue these novel products that will potentially be institutional or in a different part of market than the retail base. But especially if you're looking to unlocking collateral with things like what JPM is doing with Onyx, or unlocking the additional value from your collateral. But beyond that, I think it's just a general technology that's integrated into market infrastructure, which I don't know if the end user will necessarily know impacts them beyond the fact that hopefully it'll be less expensive and those benefits, those cost benefits will be passed on to that user.
Very interesting. But then help me with something, because I'm sure somebody's going to ask this if I don't already amongst the audience. I mean, one of the issues with a lot of blockchain technology at the moment is it can be relatively clunky and relatively more expensive in parts than existing technology, for example, for trading.
So I don't think most trading venues write all their trades to a blockchain. It's just the movement of the assets. It's where the assets exist in the first place. And I think given how that's done traditionally versus when an asset exists on chain, it's significantly less expensive for that asset to exist on chain than to work through the different siloed back offices and different players in the existing market infrastructure when it comes to traditional securities.
Okay, so essentially, I mean, as a holistic choice, you're saying that using a blockchain-based system is going to ultimately be a cheaper and safer option than necessarily using the existing series of non-distributed ledgers.
Correct. I mean, if you could look at a blockchain as just a different form of a ledger that's more efficient than the existing ledger system. And the best use case for a blockchain is the creation and the transfer of value in a way that, in a manner that people will not have the ability to necessarily manipulate or sort of mess around with that value transfer. And arguably the best use case for that, or one of the best use case, is for financial instruments, because it's literally a financial instrument that is a transfer of value. And if you're using a more efficient ledger for that, then it should be less expensive going forward.
Right. And that then brings us back to your comment at sort of at the very top of the show, which is one of the issues we also have is this huge number of intermediaries who've all got a basis point here and a basis point there in the overall non-distributed ledger picture of technology.
That, and a lot of those intermediaries are focused on defending their turf instead of creating a more efficient market infrastructure. I mean, we look at the development of electronic trading. The market has arguably been an amalgamation of different technologies built on top of each other for 20, 40, 50 years. And what that leads is to a series of inefficiencies. So you're not adding another layer to that technology. Basically, you're creating an alternative market infrastructure that's regulated the same way, under the same laws, that has the efficiencies that can't occur under the existing market infrastructure.
Now, that's very interesting, because then that brings us back very elegantly to the whole point about regulation. And it's very interesting to see how, and I don't intend to get into the players of who said what or where, but you've been a really consistent voice from day one in saying, like me, this whole thing has to be regulated. It has to be above board. It has to be absolutely without any degree of pretense that it is anything other than a regulated entity. How do you feel right at this point in time? Because obviously a lot of crypto scandals have taken place, maybe not quite in the digital market infrastructure that you're talking about, but obviously that does make life difficult when you're trying to be a thoroughly legitimate regulated business.
I don't know if it makes life difficult as much as it presents an opportunity. We're not here to be part of the masses. We're here to do what we think is the best approach to ensuring proper regulated markets and ensuring that investors are protected. And what we saw with the events of 2022 with FTX and the like is that if you don't have proper regulation, if you don't have proper segregation of customer funds and assets from that of the institution, if you don't have proper oversight with regulators who know what they're doing, when the cat's away, the mice will play. And industries, I think, in general, aren't the best at self-regulating. There needs to be some accountability. There needs to be proper oversight. There needs to be proper reporting to ensure that oversight properly occurs. And the securities laws have been tried and tested over generations, and it's just always been our mentality. There's no need to recreate the wheel.
There's no need to recreate the wheel. And indeed, as you say, it's quite interesting how every time we get a technological leap, we always seem to get essentially the same kinds of frauds and failings of companies as we got all along. They just happen to be using slightly different applications of technology. But certainly you can see a great deal of just pure play mismanagement that has gone on so far, particularly on the crypto side of the ledger of what's been happening in this new asset area. how do you feel then, going forward? Is there a way? I mean, for example, a lot of people are talking about decentralized finance. I mean, walk me through that, because, in one sense, I look at decentralized finance and I go, well, hang on a second. The whole reason we have regulation is because there's something in the middle. And decentralized finance slightly bewilders me because it seems to be upending a couple of thousand or more years of legal practice. And I'm not a legal practitioner like you.
So the decentralized or the financial, the DeFi area is interesting because a lot of the thought is, well, we don't need regulation. And I don't think that's necessarily true. I think one of the things that occurs is you sort of potentially can automate that regulation through smart contracts that ensure that investors are still protected. Now, I don't think that's the mainstream view of how DeFi should be, but you can't eliminate regulation altogether. You could potentially or hopefully make the enforcement and the application of regulation more efficient through automation. And one of the ways to automate that is through some of the advantages of what blockchains present, which are, smart contract enabled networks, which can ensure that certain mechanisms and certain regulations are enforced and are self-enforcing. But I don't think we're totally there yet. I don't think the idea of having no regulation in an area is going to work when you're dealing with customers' money and when you're dealing with the general public participating in a space. If you wanted to say, sophisticated investors, super high net worth investors, they can protect themselves, maybe. I don't even think that works. But with retail particularly, part of the securities laws are meant to ensure that retail is properly protected, because one of the issues is if retail is not properly protected and all of a sudden people are losing their money through scams and through sort of scandals left and right, at a certain point, these Wall Street type considerations affect Main Street, and the government has to get involved because of potential contagion risk or the fact that people are not going to be able to pay their bills. So, I think it's not necessarily the best view to think that regulation, it has no place in that part of the environment. I think regulation will always have a place. It's just a question of how that regulation is applied.
Right. And that then, though, brings us back to what's a very interesting thing, because it strikes me that a lot of the problem there's been around the overall industry, and again, a lot of this could be said to be on the crypto side, is there seem to be a lot of people who've just genuinely tried to be like a 3-year-old child and sort of thrown their toys out of the pram and said, well, no, it's not going to impact us. We're refusing to be regulated, which always struck me as a fast track to an orange jumpsuit.
Or you can say, when someone's offering 20% interest on an instrument, run for the hills. I mean, when have you ever seen that on the street? I think at one point, and this is semi-mythology in my universe, I'm a little too young for this, but during the savings and loan crisis, I think afterwards there was certain paper that got to 15, 16%, but that was even anomalous then. So as a general rule of thumb, and this is not investment advice, but if you see yields that are significantly higher than the Fed funds rate, run for the hills.
Yeah. I mean, I think that's a very, very good point. And you look at even the junk bond business, which I can just about remember the tail end of. And, pretty much the worst end of junk bonds were recording interest rates of that sort of propensity, but you were talking about a Fed funds rate that was running pretty much around about 8 to 10%. So it wasn't as if, you were 600, 800 basis points over. It wasn't absolutely enormous. Yes, and as a brilliant analyst once pointed out in a seminar in Sydney that I enjoyed at a technical analyst conference, just remember, if you make 15.15 to 20% per annum, and you do that for 15.15 to 20 years, they put you in the textbooks. And I also thought that was a great description of what's going on. And these people who are offering you 1 million% overnight on your absolutely weird coin always struck me as being just a little bit nuts, and usually being sold by someone who was probably the descendant of a shoeshine boy from the 1920s. So, okay, I mean, there's obviously a very, very interesting disparity here, because I think I would make the supposition that there's a kind of minority out there who are like, we're not going to be regulated. We refuse to acknowledge its regulation. Then there's this sort of rump, which is in the middle, who I find challenging. I mean, they've said some very, very hateful things against the SEC chairman, Gary Gensler, recently, etc. And I mean, this poor man has even had death threats. Now, I don't care whether you agree with him or disagree with him. It is pretty wild to be making death threats against a government official who's charged with financial regulation. I mean, that just strikes me as completely beyond the pale. But generally speaking, I mean, most of the industry seems to be gradually or reluctantly moving more towards your side of the ledger in terms of embracing regulation. What do you feel are the advantages you've had in terms of being born regulated?
When you look at the space, I think a lot of people have said, it's so hard to get licensed. So let me take a step back and explain licensing in the digital asset space versus the traditional security space. So what the government has done is that in the United States is that they've bifurcated securities licensing between traditional and digital. So in order to interact with digital asset securities, meaning on the trading, the custody side, you need to have specific licenses for that. And you can't do it under your traditional licenses. So a lot of the players in the space who tried to get in the space early were doing certain activities that were on the fringes when it came to the compliance standpoint. And then they often went in to go try to obtain the licenses for the digital asset security side. And they, at least from what's said publicly, had a hard time. Now, I don't know exactly why that is. I could say for multiple reasons, but I would say if you have skeletons in your closet, what do you think? They're going to be exercised? They could just go away? That's one point. And I would say the other thing is in the digital asset side or in the crypto side, a lot of people believe that the laws as existed were not properly constructed and that they needed new laws. And I would argue that those who say they need new laws because they can't be compliant under existing laws need new laws because they can't be compliant under existing laws. You see what I'm saying? It's not So our mentality was, these are the existing laws. Let's build technology. Let's build procedures. Let's follow the operations. Do everything such that you're compliant with the laws as came out. And I think by focusing on securities regulation and focusing on the regulations as constructed, we just put our heads down and got going. And it gave us a major advantage over other players who were worried about potentially their existing revenues from doing sort of fringe-based activities in the digital side, or beyond that, trying to change the laws to meet their needs.
Yes, it's very interesting, this whole idea of we've got a new technology, therefore all the laws must change. Whereas, as I seem to recall, I mean, they only tinkered with the Highways Act when suddenly people invented the internal combustion engine. And yeah, true, there were a few problems in the early stage because regulators made men with red flags walk in front of your car at 5 miles an hour. But, we got there reasonably quickly in terms of something that allowed the automotive economy to thrive, and thus actually the United States of America to thrive. It's a really, really fascinating one. We'll probably come back to it in a second, but actually there's a question it's so interesting. I've got to ask it to you. Jeff Cutler. Hi, Jeff, a former IPO-VID guest from the Global Association of Risk Professionals. Greetings, Patrick. Hiya, Jeff. Didn't Aaron have some interesting interactions with members of Congress? Would you care to share any impressions from your time on the Hill?
Hey, politics is politics. I mean, I think that there's been a lot of lobbying in the industry, and different people have different viewpoints. We have not focused on trying to change laws or put major efforts into the lobbying side as opposed to being compliant under existing laws. And it's sort of weird when you have big politicians making accusations against you when you're just being compliant with existing laws. And while it's a unique and interesting experience, our approach has always been to just put our heads down and focus on our business and continue to move forward. And it's very easy to get caught up in the noise or the energy surrounding the political side, but that's politics, and we focus on our business and achieving our goals of our business and our business model.
Great answer, Aaron. Thank you very much. Focusing on your business side rather than focusing on the politics. Of course, there were times in the past when business models were particularly wild and frenzied, ladies and gentlemen, and that can be discussed in our book of the week this week. It's an oldie, but it's a real goodie. Michael Lewis's Liar's Poker. Actually, I think in many ways, the book that launched the career of Michael Lewis is a behind-the-scenes memorable journalist writing incredibly interesting, must-read, non-put-downable books about markets and business. Liar's Poker was a behind-the-scenes look at a unique and turbulent time in American business, from the frat boy camaraderie of the 41st floor trading room to the killer instinct that made ambitious young men gamble everything on a high-stakes game of bluffing and deception. It's a really, really fabulous encounter about a time past, although in some ways, some might say that it's not altogether dissimilar with what has gone on in certain less regulated areas of the crypto and digital economy so far, ladies and gentlemen. If you want to read that book, you can catch the links are on our website. At the same time, don't forget you can subscribe to Exchange Invest, or indeed subscribe to BitCarnage, our daily on the business of crypto, digital assets, and the market infrastructure surrounding that. You can subscribe to that at Substack. If you want to subscribe to everything relating to Exchange Invest, including BitCarnage, you can do that at exchangeinvest.com. So, Aaron, very interesting as we're discussing here Prometheum, blockchains, and the markets and the future of finance. I mean, you touched upon, obviously there's a big political dimension. I think it's quite interesting personally, I know you may not possibly comment, but quite interesting how the political views have changed. I mean, it's quite incredible because we seem to have had an initial gold rush, then an initial regression, then another gold rush, and then it's quite incredible. And indeed, what I have to say, Woman on It's made a great remark here. Politics is politics. Love it. Lol. Was it a Mark Zuck moment in your bio, going to Washington, D.C. and having to talk to the political classes?
Oh, dangerous question. I would like to say that Prometheum nor myself has ever considered all the data ours. When you look at what I would call the Internet 2.0, which is the application layer, which the social media companies were, you could have made a strong argument that they should have been a lot more regulated than they were. There's a lot of potential implications when it comes to mental health for young kids and certain Wild West activities that occurred with social media that are arguably disgusting and that have led to a lot of problems in society. And when you look at data, as data is so powerful now, particularly in the AI universe, I think we made a lot of mistakes as a country when it came to the lack of regulation around data. And there's been a lot of lobbying effort still going on to ensure that the protection of one's own data is not really existent. So I'm not sure if that was the reference there, but I don't know, because I don't get the reference, if it was a Mark Zuck moment.
Well, I think possibly the question was asked in relation to the fact of Mark Zuckerberg. Obviously, when he turns up in Congress, it's such a big headline moment in his career when you see him appear. And definitely, one thing we certainly wouldn't like to accuse Prometheum of is being anything like Facebook, which I do believe is now the most cited platform for crime in the United Kingdom, with something like 18 or 20% of all crimes being referenced as taking place via Facebook, which is somewhere between Facebook and the UK lawyers and nothing to do with this conversation. Now, looking back to Prometheum, though, it is very interesting because, I mean, when we talk about blockchains, one of the things that a lot of people talk about is trust. When you look at old-fashioned exchanges, traditional exchanges, when you look at the traditional focus of the DTCC as the settlement CSD for the securities of the United States of America, that's all focused on trust. Is it feasible in this day and age to expect people to very rapidly trust in the blockchain? Or do you think it's going to be, as you mentioned earlier, more a case of the technology may change, people may still be effectively operating through some of the same intermediaries as before, and people just won't notice?
Okay, there's a lot to unpack here. So when we look at elements of trust, I don't think that most people who are looking to participate as an investor in the trading space, beyond trusting the platform they're on, are focused on the underlying technology. I think they're most focused on that they place a trade and that they get the best execution on that trade and it ends up in their account. So going to that point, the efficiencies introduced by having assets exist on chain will provide cost benefits that will be either maintained by an institution or passed on to their customers, and that's what people will be focused on. And beyond that, I think that people will, as long as you're operating under the same compliance infrastructure, meaning, it's the securities laws, you have the same investor protections, you have the same oversight, the same enforcement from, the same regulation by the regulating bodies, the SEC and the like. As long as you're ensuring those methodologies and the regulations as laid out under those methodologies, I think the efficiencies that will be introduced overcome any sort of potential considerations when it comes to trust. And when we look at traditional securities, the idea of trust is a little different because, particularly with DTCC, the idea is you are sort of extending that trust there because it's a consortium of the largest players who have a incentivized interest to ensure that those settlements occur, right? But when it comes to assets existing on chain, you don't need that. You eliminate a lot of that need to extend that trust to a consortium of major entrenched players because those assets exist on chain, and you can see the movement of those assets and ensure that what they're saying is occurring is actually occurring. So by having assets exist on chain, there's a lot of discussion of blockchain being trustless. Is it trustless? I don't know if that's a branding thing, but it's a lot less trust that needs to be extended than when you do it with traditional legacy securities and entities like DTCC.
Yes, it's very interesting. I'm reminded of the great one-liners by Jeff Sprecher on the topic of Intercontinental Exchange, where he was noting the fact that nowadays people seem quite happy to download an app and then use that app to get themselves a car ride home from wherever they've been of an evening with somebody they don't know and they've got no idea who it is, which is a whole new realm of trust. And the whole Bitcoin issue of crypto, which I appreciate is not the epicenter of the Prometheum model, where we're all dealing with something that was invented by some guy who may or may not have existed, who was called Satoshi Nakamoto, certainly is rather a virtual and interesting issue. I've got a couple of comments, actually. Thank you very much, Aaron. A woman on it in relation to the Mark Zuckerberg question. I agree. However, many adults may behave like underage kids. That could also, I suppose, be a comment about a great deal of the early stage adopters of the crypto business as well. But anyway, Anne Berg has asked
or the trading, or electronic trading. Too.
Oh, that's true. It's very true. That's very true. Yes. It's rather like me saying many years ago at a book launch, my mother was disappointed that I wrote books for financial markets people because she'd always wanted me to write books for children, and somebody shouted, "Aren't they always the same?" And I said, "No, the difference between children and bond traders is at least that children mature." The interesting question we have here from Anne Berg. Hello, Anne. Welcome. A previous guest on IPO-VID as well, our commodity expert, Doyen. Can you give an example of a smart contract and how it executes its underlying objective?
Sure. So you have a tokenized money market fund based on the smart contract that creates the asset, the fund itself. You have a earn or a distribution occurring at a preset time interval. That smart contract automatically ensures that earn or distribution occurs at that preset time interval. When we look at how it occurs, I think now for traditional money markets, there's a bunch of back office processes that are involved in that and a lot of people involved. And when you have human beings involved, by definition, you have more mistakes than if you have properly audited computer programs or smart contracts that ensure that. So by having that self-enforcing mechanism or effectuating mechanism through that distribution, basically the smart contract executes that underlying objective, which is that distribution of that earn on a preset time interval, which it could be at a much larger rate than at a much more frequent a rate than what occurs right now when it comes to traditional money markets.
Anne, thank you very much for that question. That was a great description altogether. And actually, there's two things that instantly jump to mind. The first one I'm thinking about here is smart contracts and the use of distributed ledgers as a whole. Clearly, that can have a very significant impact on disclosures for the future. I'm sure you've got a great deal of thinking around that, Aaron.
Yeah, so when you look at disclosure, let's look at it into two different components. You have initial disclosure, which is basically the disclosures that must be made to ensure, and this is an oversimplification, but these are disclosures that must be made to ensure that a company could have their security properly registered such that they can trade publicly, right? Think about an S1 through an IPO. Then beyond that, you have ongoing disclosure, which is your Qs, your Ks, and your I'm forgetting, but basically you're on, your current news reports, right? There's two parts there. One, and there's been discussion of this from one of the commissioners from the SEC, Commissioner Ueda, who's basically talked about the potential updating of the S1 disclosure. And this is a good example of specifically of the fact that the current securities laws work. They might not be tweaked a little bit, but basically you just need to update these documents a little bit such that then they could be sort of fit perfectly within the securities laws. And that overcomes the initial disclosure. Beyond that, you have the ongoing disclosure to question. And let's look at this when it comes to take any sort of crypto, take Solana for an example. So when it comes to Solana, the question would be, how would they do ongoing disclosure? They make arguments there's no centralized entity to do disclosure, and basically how can that happen if there's no centralized entity which will have the responsibility to make sure that that disclosure gets updated? I would think when it comes to a lot of blockchain activity, there's alternative means that have better disclosure than what currently exists. And one of the good examples of that is from the actual blockchain activity, right? You can see from a blockchain explorer how much activity is occurring on that blockchain. You could see the number of smart contracts deployed. You could see the hash rate. Basically, you get an up to the moment update about what's actually occurring on that blockchain to make sure that when you're making an investment decision, which is the whole point of disclosure, that you have a good idea of what's going on. Now, when you look at traditional securities, I think there's the disclosures, you have your quarterly, your annual, and your current news, but it's a lot more formulated. It's a lot less updated and occurs at a preset sort of time period. So if you're taking that versus what can occur from getting ongoing disclosure from a blockchain on a minute by minute or a day-to-day basis, you can make a strong argument that having the blockchain data being the means of ongoing disclosure really satisfies that, such the ultimate investor could make an even better investment decision than they would do with traditional securities.
That's very interesting. Let me ask one question, which is slightly off the wall, but I'll give you the example. When markets were open outcry on the floor and someone made a mistake, actually it was not that difficult to undo the trade because people could see in real time some human melting down and a lot of screaming going on and people going, golly gosh, how inopportune, and other words and phrases that we might not be able to use on these networks. And you then had a situation, a process whereby people could say, oh, that Patrick made a mistake, we're undoing the trade, those trades are off. When that went electronic, you went and tried to do the same thing, suddenly became quite difficult because it was opaque and people went, well, why did they let that trade get cancelled? That sounds like they were doing something dubious and a lot of trust was lost. With a blockchain, with these sorts of issues or whatever, are smart contracts so smart that everything's going to be perfectly reasonable and there won't be any errors? Because I am of the opinion that every time we get technology, we just end up with a slightly different and more interesting series of errors, even if some errors do actually go away.
Well, there was no fat fingers with open markets, right?
You're right.
Exactly. you will encounter new problems. I guess the ultimate consideration is, do you eliminate enough of a percentage of the existing problems that the potential for new problems makes sense? And I think here you genuinely do. And particularly when you look at the broken trades on the settlement side, instantaneous settlement eliminates, I don't want to say all of it, but it really should eliminate a very, very, very high percentage of it. Yeah. So by eliminating this massive problem, if you encounter some other additional problems, is that an offset that makes sense? I genuinely think it is.
Yeah, I mean, I agree with you. I mean, you still are going to get the Handmag securities incident, which took 143 seconds for the Korean market maker to melt down when one of its bots went completely ballistic. But you eliminate a huge number of other problems that you would have previously had if you had T+21 day settlement or something like that, as we had a few hundred years ago between Holland and the UK. So that reduces a lot of issues. Let's turn that on its head then. One thing I can see here is presumably there's a big opportunity because with faster settlement and a lot of smart contracts and therefore things being paid out much faster and so on, that must change radically the face and shape of collateral.
Yeah, I think there's been a lot of focus, particularly from the major institutions and sell side, on the potentially unlocking additional value from your collateral by having those assets exist on chain, so that you could have instantaneous settlement, less broken trades, and basically potentially, and I don't know what I think about this, having alternative forms of collateral be used as a means of getting you additional buying power margin. And we've seen, I think, particularly with entities like JPM with their Onyx, which is, I think, at the moment just an internal collateral system, or beyond that, when it comes to places like, I know Franklin Templeton has their Benji token, which is a tokenized money market, and so does BlackRock has BIDL, or I think are trying to move towards that becoming a means of collateral. But the issue is right now, all of those entities use arguably closed systems, and you have to be within those universes to use that collateral. I think the next step is sort of different means of issuing tokenized collateral on chain such that they can be used in open systems. They can be used on different blockchains. They don't have to be used within the Franklin Templeton or the BlackRock or the JPM universe. And that will be the next step in terms of unleashing significant potential from tokenizing different sort of securities or having different sort of means of collateral existing on chain.
That is fascinating. Now, does that therefore open up one very, very simple thing, which is if you have more assets on chain, you can potentially use more of that as collateral in the future against transactions?
Yes. I mean, in theory. So like one of the things that's very interesting is that my background is market infrastructure securities, and in order for there to be these alternative forms of collateral coming on chain, the first thing you need is the market infrastructure that allow for the public trading and then the clearance, settlement, custody of those assets, meaning on the digital side, right? Which means you have to have specific license for that. And that's really what Prometheum does. We basically provide that infrastructure layer with the licenses that could allow that collateral to be tokenized and then traded publicly and do the post-trade side as well, which is really the first step because you need to have the infrastructure. The next step beyond that is these major institutions issuing these different sort of types of collateral that sort of unlock potential value from existing collateral or from alternative means of collateral, which then takes advantage of that market infrastructure. So Prometheum is now at the point where we are live with our custody through our special purpose broker dealer, Prometheum Capital, and we'll be going live with trading very soon through Prometheum ATS, such that now that collateral could come online and it could be used to unlock additional value.
And that is really very, very interesting. So just explain for the viewers, where does Prometheum sit as an enterprise? I mean, are you a B2B provider of services to other existing regulated entities, or are you also your own custodian, etc.?
I think we're both. I should say, I think I know we're both. So on the one side, when we talk about collateral and we talk about major institutions in the space, the primary means by which institutions are participating in the space is by issuing their own tokenized assets on chain, meaning tokenized securities on chain. And we basically are the infrastructure that allows that tokenized asset to have it be empowered afterwards, because once it's issued, it has to be able to be traded publicly and clear, settled, and custodied, obviously, because it's traded publicly in order to be empowered. And what Prometheum is on that infrastructure side, beyond having built the technology, we also have the licenses to allow for the public trading of that asset through Prometheum ATS and the clearance, settlement, and custody through Prometheum Capital, which is our special purpose broker dealer. So you empower the sort of institutional participation in the space through tokenization and through being the infrastructure for tokenization, but you're also the infrastructure by which the general public, meaning our licenses are both for institutional and retail, that will allow just anyone looking to participate with digital asset securities to purchase those assets and to custody them thereafter.
Very interesting. Very, very interesting. So, I mean, in terms of your ATS per se, explain to us a little bit more about what sort of content is eligible and indeed has been traded on that. So
our licenses for both the special purpose broker dealer and the ATS are for digital asset securities, which are essentially just 33X securities issued on chain. That could be equities, it could be debt, it could be options, it could be money markets, it could be treasuries, it could be structured products, and it could also be investment contracts, which is the catch-all, which is how crypto gets regulated under the securities laws. So we don't call it crypto, we call it a digital asset security an investment contract digital asset security. And that's how you also have the crypto side under the securities regulation. Now, obviously that's a big part of the market, and we are unique in the infrastructure we provide there. But I think the majority of the growth in the space going forward will come from institutions issuing securities on chain. There's so much discussion about tokenization, and tokenization is really just securities on chain. But in order for that to be empowered, you need the market infrastructure that allows those tokens to be traded thereafter and then custodied or clear settled and custodied. Because I don't know, we probably both agree on this, that we're trying to do real trading, meaning public market trading, not have some sort of a liquid private market trading. And in order for that to occur, you have to be able to do the post-trade side as well. And that's sort of the infrastructure we built.
Yes, I think that's very interesting, because it is important to emphasize, because a lot of people have their own little private networks and things which they're using a blockchain within, etc. You're really trying to create here, for want of a better term, the word I always use is super liquid. I mean, the things that are going to trade potentially all of the time, all in. Let me ask you a question about that, though. Does that mean that your vision is that we're going to be, I don't know, 12 times 5, 24 times 5, or 24 times 7 as we go through the week of trading?
So it's interesting. The goal is to be able to be open as long as possible, as long as it makes sense. That might seem abstract. But like right now, a lot of the crypto markets are 24/7. Now, the issue there is if you follow crypto market patterns, because of the liquidity on weekends or on weird times of night, you can argue that certain people trading at that time can have more influence over markets. So there's a bit of a risk there. You have to make sure you can sort of consider that and ensure that you're not allowing certain whales to move prices at certain weird hours because they're just taking advantage of certain market illiquidity times. But I also think what we've seen recently, and you will know more about this than I will, Patrick, there's a U.S. equities ATS or exchange that was
Blue
just permitted.
Ocean. Blue Ocean, which is Blue Ocean were on this show about 3 months ago, ladies and gentlemen. It's a great show with Brian Hyndman. Yeah, they're trading from essentially like 8 or 9 o'clock at night in the US time all the way through to 4 or 5 o'clock in the morning. And that is effectively the same time as most Asian markets daytime.
So we're already seeing a transition in the traditional markets towards adding additional hours with the goal of, you could have a different philosophical conversation about this, but I guess the goal is to be 24/7, 365, or not 365 without holiday. You have holidays, but 24/7 with instantaneous settlement. And we're very close on the instantaneous settlement side with the goal of adding more hours to our trading times. So given that our licenses are for 33X securities, which, as I mentioned, is quite expansive. It's almost all traditional securities in addition to crypto via the investment contract digital asset securities. It sort of just shows how you're building an upgraded market infrastructure that can overcome a lot of the issues that have existed historically. I mean, the 24/7 is one component, but beyond that, we've seen recently the transition from T2 to T1 in the United States. And there's been a lot of articles recently that's caused a lot of headaches, and it's because it's still not fully there. So we can arguably solve both those problems.
Yeah, it's interesting actually, because one of the things that Blue Ocean has effectively done is solve the T+1 problem for Asia. Because if you trade tonight in US trading hours, you're actually outside of today's window. So you're on settlement for effectively tomorrow's cycle. So you're going to go into the NMS tape tomorrow morning at 5 or 6 o'clock in the morning pre-market. Then you're going to be part of tomorrow's session, which means you won't settle until the next day, which effectively means you've still got T+2 if you execute in Asia, which gives you the chance to move your money and do everything like that. So it's quite curious how inadvertently, or perhaps it was all part of their great master plan. I mean, Brian Hyndman's did such a good job. That's how Blue Ocean have effectively made T+1 a lot easier for Asian investors into the US stock market. So yeah, there's a lot of workarounds and potential. Okay, look, I mean, we're coming towards the end of what has been an absolutely fascinating conversation during the course of time. I think one of the key issues that you brought out here is how important the whole area of compliance is, how important it is to be regulated. And indeed also, I mean, as a non-lawyer, I have to say, the basis of US securities regulation, the 33, 34 Securities Exchange Acts are absolutely beautiful. I mean, even I can manage to understand them by reading them. The stuff that's gone subsequently is a little bit more complex, and that's definitely where you need your counsel, no doubt along the way. What do you think about, how this is likely to work in terms of the future of disclosures, and what other impacts you're likely to see, do you think, on compliance in the sort of short to medium term as we get to what I presume you think is going to be everybody on your side of the ledger, i.e. regulated entities in the world of using digital assets, blockchain infrastructure, and so on?
So there's different components of disclosure beyond on the issuer side. So from the platform side, it's just a question of complying with how the regulations are laid out for digital assets. A lot of the disclosures you have to make are specifically stated there, or the gist of what you have to say is stated there from the SPVD release and the other releases having to do with digital assets. But beyond that, I think the more focused area, the area where there'll be a little bit more changes, is how these institutions who are looking to participate in the space will have to deal with from an operational standpoint. And, that's a WSP and an operational consideration to make sure that you're being compliant with how the regulations laid out for digital asset securities work. So I think that's where a lot of the effort will be from disclosure in terms of, making sure that there's disclosure for the users who are signing up for your platform. That's pretty well stated through the regulations. So there's probably a heavier lift on the operational side, but that's, again, just like any other sort of update to securities processes, part of how the industry works as you evolve.
Which, on the point of evolution of the securities industry throughout, and the evolution into revolution of the revolution and through evolution, as we've been discussing, leads us to the final question of today. So Aaron Kaplan, thank you very much for joining us for Prometheum, Blockchains, Markets, and the Future of Finance. There was a book once talked about the future of finance. Aaron, where do you think the capital market revolution goes next?
I think a major part of the capital market revolution is going to involve tokenization. And you see Larry Fink and other major players discussing how tokenization is the next big thing. And tokenization, in terms of just a means of issuing your assets via cryptographic tokens, such that they could take advantage of blockchains and the efficiencies they introduce, I think is the next part of the evolution of markets. But in order for tokenization to really be empowered, you need the market infrastructure that can allow for that public trading, clearance, settlement, and custody of those digital asset securities. And that's what Prometheum has created. And from that sense, we really hope through Prometheum ATS and Prometheum Capital to be a major contributor and a major player in the next evolution of markets.
Well, I think it's going to be fascinating to see where this goes, and I very much hope that we're going to get a chance to catch up as markets continue to evolve and Prometheum continues to evolve with them. Thank you very, very much for joining us today from New York, Aaron Kaplan. We've been discussing Prometheum, blockchain, markets, and the future of finance. I want to say a huge thank you to the production team today. Thank you very much to Desiree, Herminia, Ruslan, Beata, to our commentators, Beata Young, Woman on It, Jeff Cutler, and Anne Berg. Thank you so much for those terrific questions throughout. It's been a very, very informative discussion from start to finish. Next guest we're looking forward to next week, IPO-VID number 155. Going to something slightly different. We're going to be looking at credit markets, credit rating securities, empowering risk management in credit markets. Our guest for that is going to be Patrick Wood. He's got some fascinating comments to discuss and his interesting new product, which I think is going to really drive forward a very, very interesting opportunity for markets of the future, whether or not it's on a blockchain. So, ladies and gentlemen, my name is Patrick L. Young. I want to say thank you very, very much for watching us today from Miami and New York simultaneously. Magnificent show. Thank you once again, Aaron, for participating. And it only remains for me to say I wish you all, ladies and gentlemen, a great week in life and markets, and we'll catch you next Tuesday for the next IPO-VID. Thank you once again, Aaron.